pending receiver from the market.
Okay. All right, Mr. Singh, we'll leave it at that. Thanks a lot for joining us and, taking us through the business as well as the way forward. Dhananjay, if you were listening into that conversation, any thoughts on NHPC? There's lots happening in the renewable energy space. Of course, it will take time, about a year or two, before some of these projects reach fruition. But from a stock market perspective, do you like this space?
No, so the thing is, earlier I used to like this space. I think the thing is, as far as the stocks are concerned, the stocks haven't really done much. It's a very capital intensive business. It takes time, and there is competition as well in terms of rates, etc. So I think for that reason, I haven't been venturing in this space for a long time. So I would generally avoid it, actually, from a market standpoint.
So, Dhananjay, what are you buying in this market right now after the recent rally?
So the thing is, what we are basically looking at is the domestic consumption space, the durable space, and even autos. I would say, these are things that have actually done very well. So we are generally overweight in that space. We have also increased weights in pharma because we think that there can be some kind of volatility, and there are certain value plays that we have identified, such as Zydus and Sanofi, etc. We also like Dr. Reddy. So we have sort of increased our weights there. We have also increased weights in some of the utility companies such as NTPC, etc. So so that's the general construct that we have as far as the portfolio is concerned. So yeah, that's how we are positioning ourselves.
Okay. Just a quick word on some of these names in the capital goods space, which have been doing exceptionally well lately, whether it's ABB India sitting at a fresh high, Siemens has been doing well, L&T too.
Yes.
What would your pick of the pack be there?
So here we are sort of looking at, things that are, more visible in terms of order book, etc. So we have PEL and we have Bharat Forge in the industrial space. So what we are basically, in terms of the analysis that we've done, we think that a large part of increase in order book, etc., has been driven by exports and export orders, the price realization, which is actually linked to commodity prices. So generally, we are seeing industrial and cap goods sector actually benefiting from there. I think that's been the story of the last 1.5 years. In the current year, I think there has been very high volatility as far as cap goods are concerned. If you look at the cap good index, actually decreased by almost like 25%, and it rebounded almost like 30%. So it's actually reaching nearly the all-time high, especially the manufacturing index. My sense is that we have to be careful over here, because if a lot of cap goods companies are benefiting from high commodity prices, I think we are looking at lower, realization going forward, especially relating to metals, etc. So we are sort of cautious about the rally that has happened at this juncture. So it's kind of a very valuation intensive, and we are seeing that globally also, because a lot of dependencies on exports. The PMIs globally for manufacturing sector has been falling. So we looked at something like 95% of PMIs across major economies actually decreasing in July, and roughly about 65% are in contraction mode. So I think we have to be careful in this kind of environment. And so we have to be really looking at companies that have strong visibility. The companies that I talked about have very strong presence across multiple things, including defense, e-vehicles, commercial vehicles, etc. So I think these are the stocks that we would like. I think if metal prices are also falling, there can be operating performance improvement in these two companies, PEL and Bharat Forge, that I mentioned.
Okay, thanks a lot. Thanks. We'll just do one thing. We'll take a quick commercial break. We'll come back to you, Dhananjay, in just a bit. For now, we have the pre-opening rates kicking in minutes from now.